GDP comes up constantly in Forex conversations. It's referenced in economic news, central bank statements, and analyst commentary almost every week. And yet, for most traders, it remains a surface-level concept. They know it matters, they're less clear on why, and even less clear on how to actually think about it. And that's what this video is about. I'm not going to walk you through a setup or tell you how to enter a trade based on a GDP release. That's not what this is. What I want to do is give you a clear structural understanding of what GDP actually is as a currency driver, what it reveals, what it doesn't, and how it fits into the longer-term thinking that position trading demands. Now, if you approach Forex from higher time frames, then economic fundamentals aren't noise to filter out. They're part of the story you're reading. And GDP is one of the most important chapters in that story. But like any complex piece of information, it's easy to misread if you don't first understand its structure. So, let's slow down and build that understanding properly. GDP stands for Gross Domestic Product, and at its core, it measures the total value of all finished goods and services produced within a country during a specific period, usually a quarter or a year. It's built from four components: consumer spending, government spending, business investment, and net exports. That's exports minus imports. And each of those components tells you something different about where economic activity is coming from. Now, here's what GDP is not. It's not a real-time indicator. It's not a live signal. It's a backward-looking summary of economic activity that has already happened. And by the time GDP data is published, the period it covers is already complete. And that is a very important detail. There's also an important split inside GDP itself, the difference between nominal and real GDP. Nominal GDP measures output at current prices without adjusting for inflation. Real GDP adjusts for inflation and shows whether an economy actually grew in terms of productive output or whether the numbers just look bigger because prices rose. For anyone thinking structurally about currency value, real GDP is the number that matters. Nominal GDP can be misleading, especially during periods of high inflation. Real GDP gets closer to the truth. When I reference GDP as a currency driver, I'm thinking about real GDP growth, actual expansion of economic output over time. GDP emerged as a concept because markets, governments, and central banks needed a standardized way to measure and compare economic performance. Before consistent national accounting systems existed, understanding whether an economy was growing or contracting was genuinely difficult. GDP solved that problem. For currency markets specifically, GDP matters because currency value is ultimately tied to economic health and capital flows. When an economy produces more, businesses expand, employment tends to rise, and investment becomes more attractive. And that combination draws capital into a country. More demand for a country's assets means more demand for its currency. That's the structural connection. It also works in the other direction. When GDP contracts, confidence falls, investment slows. Capital may leave the country in search of better returns elsewhere, and that reduction in demand puts downward pressure on the currency. Central banks pay close attention to GDP growth precisely because of this relationship. Sustained economic expansion can signal rising inflation, which may lead to higher interest rates. Contraction often leads to rate cuts to stimulate activity, and because interest rates are among the most powerful drivers of currency flows, GDP becomes a leading input to monetary policy, which then directly affects exchange rates. That chain, GDP to monetary policy to interest rates to currency flows, is why GDP sits near the top of the hierarchy of fundamental indicators for position traders. I don't look at a single GDP number in isolation. I look at the trend, the composition, and the context. A single quarter of strong growth tells you something. A consistent series of quarters tells you much, much more. Sustained GDP expansion signals structural strength. A one-quarter spike followed by a weakness might just be a temporary factor. The trend matters much more than in the individual data point. Composition also matters. Strong consumer spending looks different from growth driven entirely by government expenditure. One reflects organic economic activity, which is great. The other may reflect a short-term stimulus that won't persist. Professionals read the components, not just the headline. And perhaps most importantly, GDP is always interpreted in relative terms. A currency doesn't just strengthen because its country's GDP has grown. It's strengthened, or it doesn't, based upon how that growth compares to other economies. If a major economy reports strong GDP, but its trading partners report even stronger growth, the currency may still underperform. Relative performance is what drives currency flows, not absolute numbers. There's also the question of expectations. By the time GDP data is officially released, markets already have formed a view. Analysts, economists, and central bank communications have shaped an expectation. What moves prices at the moment of release isn't the number itself, it's the surprise. The gap between what the market expected and what actually came in is what creates the immediate reaction. And that distinction is what matters most. The most common misunderstanding about GDP is treating it as a trading signal. Traders see GDP data, assume the currency will strengthen, and act on that assumption without considering the surrounding context. Sometimes that works, but often it doesn't. And when it doesn't, the confusion is significant. The breakdown usually happens in one of a few places. First, there's an expectation gap problem I just described. Strong GDP data that was already priced in can actually cause a currency to weaken because there's nothing new for the market to buy. Now, this is counterintuitive, and it catches many traders off guard. Second, there's the issue of lagging data. GDP tells you what happened 3 to 6 months ago. By the time you're reading it, other indicators may have already been pointing in a different direction. Employment data, PMI readings, inflation figures. These can all be telling a more current story that doesn't fully match the GDP report. Treating GDP as current information when it's inherently backward-looking is a structural error. Third, GDP doesn't capture everything that matters. It doesn't measure income distribution. It doesn't account for environmental sustainability. It does nothing directly about political stability or institutional confidence. A country can report solid GDP growth while experiencing significant underlying fragility. Those limitations don't make GDP useless. They just make it incomplete. Treating it as a comprehensive verdict on economic strength is where the real misinterpretation begins. For position traders like me, GDP fits squarely into the fundamental backdrop of a trade thesis. It's one of the key inputs you use to assess the relative economic strength between two currency blocks over time. If one economy is consistently expanding and another is stagnating, that divergence tends to express itself in the exchange rate, often over months, not days. That's where GDP has genuine value in position trading. It helps establish structural context. It informs your view on where monetary policy is heading, and it gives you a basis for comparing the long-term attractiveness of one currency against another. But what GDP does not do well is provide timing. It cannot tell you whether to enter a position or whether price will move next week. It cannot tell you, replace technical structure, price behavior, or the broader multi-factor analysis that position trading requires. Using GDP alone as a basis for a position is incomplete thinking. GDP also doesn't work well as a short-term trigger. The release day volatility that GDP data creates is real, but it's the domain of short-term traders who specialize in event-driven moves. For a position trader, that volatility is more often noise than something we need to be aware of or a signal to act on. Think of GDP as one layer of the picture, a meaningful layer, but a layer, not the whole canvas. Structural understanding of a concept like GDP doesn't produce immediate results, and that's not the point. The point is to build a decision architecture that holds up over time, one where your analysis is grounded in how markets actually work, not in simplified cause and effect assumptions. GDP tells you about economic output, and real GDP tells you whether that output reflects genuine growth. The growth rate indicates the direction the economy is heading. GDP per capita gives you a sense of prosperity. The limitations of the data remind you that no single indicator is complete. And announcement dynamics explains short-term market reactions, and interpretation and context is what separates structural thinking from reactive thinking. None of the 7 dimensions operates in isolation, and none of them on their own define a trade. What they do is inform a framework, a way of reading the economic landscape that becomes more useful the longer your time frame extends. If you want the full written breakdown of all 7 dimensions of GDP in Forex trading, including how each one connects to currency dynamics, the complete article is available at positionforex.com. The link is in the description below, and it covers everything we've discussed here in greater depth and gives you a reference you can return to as you continue building your analytical practice. Until next time, best to your trading.